What is up, everybody? This is Books of the Stock Market. I hope everyone is doing well. This is the Sunday report where I cover the top articles from Monday through Friday. At the end of each article, I'll be giving my thoughts on how the article could impact or has impacted the financial markets. Without further ado, let's get into this week's Sunday report. On Monday, Senator Elizabeth Warren and other progressive Democrats proposed a 3% total annual tax on people with wealth over $1 billion. On top of that, they proposed a 2% annual wealth tax on people with a net worth between $50 million and $1 billion. They believe that only 100,000 Americans will be affected by this tax. Furthermore, they estimate they will earn around $3 trillion off this tax over 10 years. If this bill were to pass, then Elizabeth Warren believes that they will need to invest $100 billion into the IRS so they can accurately score the net worth of individuals. However, many analysts believe this bill will be extremely hard to pass as the Senate is a 50-50 split between the Democrats and the Republicans. Personally, this does not seem to be a bad move as the wealth gap has increased extremely in the past 10 years. However, I also really doubt this bill will pass in the Senate as the Senate is a 50-50 split. Furthermore, we already saw progressive ideas such as the $15 minimum wage already taken out of the current stimulus bill. On Monday, we saw Bitcoin recover a bit. Bitcoin rose 7% and is at $49,160 at the time of recording. Citi believes at this moment Bitcoin is at a very important spot. They believe that with companies like Tesla and MasterCard, we could see other companies jump in. Furthermore, they state the recent rise in crypto is mainly due to institutional investors. This in itself may convince other companies to jump in as companies do not want to be left behind. Citi also cited the technology around Bitcoin has increased dramatically compared to 2017 when Bitcoin last rose. This has caused emerging markets such as Nigeria to use Bitcoin as a payment tool as it is more efficient and cheaper now. I chose to cover this article because I wanted to see a bank's perspective on Bitcoin. There was not much to gain out of this article as we already knew institutional investors are stepping in this time and Bitcoin will continue to become more efficient as time goes on. Gina Raimondo was confirmed by the Senate to be the next Secretary of Commerce. Cecilia Rouse was another individual confirmed on Tuesday, and she will be the chair of the White House Council of Economic Advisors. Gina Raimondo was the governor of Rhode Island and a venture capitalist, and many are expecting her to use her experience to handle all the tasks. Many believe her main task will be creating new jobs from the upcoming infrastructure plan. She's a Democratic centrist and she has in the past put fewer regulations and reduced taxes on businesses. Dr. Rouse is the dean of the Princeton School of Public and International Affairs and is the former member of Obama's council. From her testimony, it seems like her focus will be on racial and gender equality in the economy. This is kind of important, especially Gina Raimondo's job. Under Trump, the Commerce Department played a role in trade policy. For instance, they're the ones who put tariffs on imported materials from China. It is not clear how much power Gina Raimondo will have, but as she is a centrist, this appointment favors businesses, which is always a plus for the financial markets. On Wednesday, Exxon stated it will cut costs so they can preserve dividends. They have been overspending in the past years, but it looks like for this year they will lower spending by decreasing oil and gas output. Exxon Chief Executive Darren Woods said they will be rebuilding the balance sheet where the focus will be on reducing spending and debt. They expect to see $2 billion just from workforce reductions. In the past year alone, they cut 15% of their workforce. Also in the past year, they suffered from a historic loss of $22.4 billion. Furthermore, Exxon was dropped by the Dow Jones Index. Many investors are pushing Exxon to step away from fossil fuels. However, Exxon is shifting their focus more to oil and dropping gas behind. This move is the opposite of other oil companies like Chevron who are looking towards renewable energy. However, they did say they will be increasing investments for carbon capture technology from 1% to 3%. Well, if anyone's holding Exxon, the future does not look so bright. This is a company that knows people are only holding the stock for dividends. They could have lowered the dividends and used that money to invest in their own company, but instead they're giving up on some projects and trying to stem the losses by cutting its workforce. Exxon is out slightly for the day, but that is expected as they announced they are cutting the workforce, which means higher profit margins. On Wednesday, private payrolls increased less than expected in February. Many analysts were expecting private payrolls to increase by 177,000 jobs. However, in February, it only rose by 117,000 jobs. This is also less than January's 195,000 job increase. This decrease in jobs is due to an increase in being unable to fill vacant positions with qualified applicants. The lack of qualified workers may be causing bottlenecks in the supply chain, which exacerbates the problem even more. In the end, this signals the labor market is struggling to reach pre-COVID heights. This is a worrying trend as $900 billion were already injected into the system last December. Personally, this does not look good as the stock market is already pressured by rising yields. If the workforce is having difficulty recovering, in addition to bonds rising, then the stock market could be in a lot of trouble. On Wednesday, WTI jumped to 61.40. Saudi Arabia and Russia talked to each other on Wednesday about Russia increasing output. The specifics about these talks are not known, but from the previous meetings in the past months, many are expecting oil to rise. For instance, in January, Saudi Arabia sporadically announced they will be cutting 1 million barrels of oil. Russia, on the other hand, would like to increase the output of oil going into April. With so many unknowns, we saw oil rise during the day. The official talks are scheduled on Thursday, so I'll be giving an update on this situation. In short, if oil rises, then it's not good for the already pressured stock market. On Thursday, it was announced that OPEC Plus will continue to tighten their oil production. This sent oil soaring. The WTI is up 4.59% today, and this further pressures the global economy. Saudi Energy Minister said he believes the current global economy can handle the tightly controlled oil production. The Saudis are expected to withhold 7 million barrels a day from the market, which is nearly 7% of the global supply. This was surprising because many people are predicting oil production to increase as countries around the world are reopening. However, since this did not happen, many people are worried about inflation. Inflation accelerating is not good for a recovering economy, and this could be a problem for the central banks. The Biden administration did not respond to this news so far. Obviously, oil rising in an already pressured market is bad. In short, oil rising causes inflation due to everything getting more expensive as oil is a very crucial part in the global supply chain. If you thought the oil news was bad, you're going to be surprised about Jerome Powell's speech on Thursday. Jerome Powell gave the same response in that the Fed will be looking at the economy and will be patient about tightening monetary policy. This is not what the markets wanted as the S&P 500 is down 1.34% while the Nasdaq 100 was down 1.73%. The markets were expecting Powell to address the problem surrounding the rising yields, but instead Powell decided to ignore the problem and continue saying monetary policy will remain unchanged. I think the markets are expecting Powell to at least acknowledge bond yields rising is a problem and maybe provide a few potential solutions. However, since he said monetary policy will remain unchanged, this means there is no additional help to combat the rising yields. I think a popular solution to this problem that has been lingering around on the internet is capping yields. However, it became clear that Powell is not willing to address the rising yield situation. We also saw the 10-year Treasury note break through a very important resistance line, which is not good as yields have been trading under this line for a little more over a year. With the Fed not willing to act, the markets will look towards the Biden administration for aid. As yields rose, mortgages rose as well. In 7 months, mortgage rates are above 3% for the first time. Rising mortgage rates could threaten the real estate boom, which has been climbing ever since last year. Damage can already be seen as the real estate buying frenzy has decreased in the past month. However, the real estate market is still far from being completely destroyed. Rates still remain lower than last year. Currently, rates are at 3.02%, but at the same time last year, rates were at 3.29%. On top of that, the value of properties are still worth double the price due to incredible appreciation in the past year. As there are still numerous positives within the real estate market, people are seeing this as a short-term consolidation period. It is obvious the rise in mortgage rates is caused by bond yields rising. Bond yields rising mean that interest rates are rising. Since interest rates are rising, it allows banks to also raise mortgage rates appropriately. For now, I have no idea where bond yields are going to go from here. I'll probably have to do some technical analysis to see where the next resistance level is at, but yeah, it's not looking so good. The main news event on Friday were job numbers. It was reported in February 379,000 jobs were added. Many attribute this growth to restaurants and bars reopening. February job numbers were the strongest ever since October. Unemployment went down 6.2% from 6.3%. However, there are some negatives. Around 9.5 million jobs seem to be lost forever. Also, the portion of people who are jobless for the last 6 months grew, which further signals some jobs may be lost forever. Furthermore, although there was a recovery, we're still lagging very behind pre-COVID numbers. Overall, the market seemed to like this news as we're almost up 2% for the day. With more states like Texas reopening, I believe job numbers can only get better from here, which is always a plus for the financial markets. So what are my thoughts on this week? Yields broke an important trend line due to the Fed deciding not to help the markets. On top of that, oil will add further pressure to the market. Currently, there are a lot of inflationary pressures on the stock market, which could cause a further correction. I think I need to do some technical analysis on the 10-year to see where the next resistance level is at. Well, that's it for me. If you like this video, press the like button. If you have any questions, leave a comment below. If you don't want to miss out on any future content, press the subscribe button. Thanks for tuning in, and I'll see you around next week.